Something big happened in October, and almost no one in the mainstream media talked about it. While most investors were focused on stock earnings and interest rates, China made a quiet move that could reshape the entire global silver market. China's Ministry of Commerce announced new licensing rules for silver exports, and those rules will officially begin on January 1st, 2026. This decision replaces the quota system that had been in place since the year 2000, which means the old way of doing business is officially over. At first glance, that might sound technical and boring, but it is anything but small. China controls between 60% and 70% of the world's silver supply through its refining power, which gives it massive influence over how much silver actually reaches global markets. When a country with that kind of control changes the rules, the impact is not local, it is global. This is not just about trade paperwork or small policy updates. This is about control over a critical resource. And when control shifts, power shifts with it. Here at Alex Carter Reports, we break down stories that most financial outlets ignore until it is too late for everyday investors to react. Today, we are going to explain exactly what happened, why it matters, and what the data is telling us about where silver may be headed next. This is not hype, and it is not fear. It is about understanding the bigger picture. Before we go deeper, make sure you are subscribed to Alex Carter Reports, because we are building a community of people who want clear facts instead of headlines designed for clicks. We focus on the numbers, the policies, and the real-world consequences that often get buried under noise. Also, check the description for ways to stay connected, because when markets move fast, information matters even more. Now let's step back and look at the current situation, because the numbers are powerful. In 2025 alone, silver has surged roughly 142% to 147%, making it one of the strongest performing assets of the entire year. That kind of move does not happen by accident. Many analysts point to ongoing supply shortages that have lasted since 2020, combined with rising demand from electric vehicles, solar panels, and artificial intelligence data centers. All of that demand is real and measurable. Electric cars require silver for electrical systems. Solar panels use silver for conductivity, and AI infrastructure depends on advanced electronics that also require silver. But here is what many people are missing. This is not just a basic supply and demand story. This is also about geopolitics, national strategy, and economic competition. This is about countries protecting resources they see as essential for the future. This is about resource nationalism, where governments decide that certain materials are too important to freely export. And when you connect the dots, you start to see a much larger pattern forming. China is not only adjusting trade policy, it is positioning itself in a world that is becoming more divided. Tensions between China and Taiwan have been rising, and that tension affects more than military headlines. Strategic materials like silver are used in defense electronics and advanced weapon systems. If a country controls a large share of a material used in military technology, that control becomes leverage. Now let's look closely at what China actually did. In late December 2025, China released a whitelist of 44 companies that are authorized to receive export licenses for silver. Every single company on that list is either state-owned or strongly connected to the government. That detail matters because it shows clear intent. The government is choosing which companies get access and which do not. This means domestic Chinese firms have priority. Electric vehicle makers like BYD gain easier access to silver. Technology giants like Huawei gain easier access as well. Chinese solar manufacturers are also in a strong position. Meanwhile, companies outside of China now face uncertainty and potentially higher costs. For decades, many Western, Japanese, and South Korean firms depended on steady Chinese supply at predictable prices. Now that assumption is being challenged. The strategy is simple but powerful. If you control supply and you limit exports, you can raise costs for your competitors. When competitors face higher input costs, their products become less competitive. For years, American companies focused on efficiency and lean inventory systems. Just in time, production became a symbol of modern business excellence. Warehouses were kept small, and supply chains were optimized for speed and cost savings. That system worked well in a stable global environment. But in a world of rising tension, efficiency can quickly turn into vulnerability. Now let's talk about price differences, because this is where things get even more interesting. From late 2025 into early 2026, silver prices in Shanghai began trading at much higher levels compared to London and New York. The premium started around $8 per ounce in late December and climbed to roughly $20 to $25 per ounce by late January 2026. That is not a small difference. A $20 to $25 premium per ounce is a major signal in commodity markets. Under normal conditions, traders would quickly buy cheaper silver in the West and ship it to Shanghai to sell at the higher price. That process is called arbitrage, and it usually balances prices between regions. And in this case, traders are doing exactly that. They are buying silver in Western markets and sending it east to capture that premium. But here's the catch. Every ounce that moves from London or New York to Shanghai reduces Western inventories. And those inventories were already under pressure. Data shows that London's LBMA vaults held about 31,023 metric tons of silver in June 2022. By March 2025, that number had dropped to around 22,126 metric tons. That is a decline of nearly 1/3 in less than 3 years. On the COMEX exchange, registered silver inventories have fallen about 70% since 2020. Recently, registered silver dropped below 100 million ounces for the first time in modern tracking history. That number matters because registered silver is the metal available for delivery against futures contracts. When physical metal declines but paper contracts remain high, stress begins to build in the system. For years, global markets assumed that supply would always be available. COMEX, LBMA, and Shanghai prices usually moved closely together. Now we're seeing a clear split. That split suggests the global economic system is fragmenting. The old model of smooth globalization is showing cracks. Western price discovery has long depended on large futures markets in London and New York. But those paper markets rely on confidence that physical metal can be delivered when requested. If physical supply tightens, confidence can weaken. And when confidence weakens, pricing power can shift. What we are watching right now is more than a short-term trade imbalance. It may be the early stages of a structural shift in how silver is priced and who controls that pricing. The question is not whether change is happening. The data already shows that it is. The real question is whether investors are paying attention early enough to understand what it means. At Alex Carter Reports, we focus on connecting these dots before the headlines catch up. Because by the time the story becomes obvious to everyone, the biggest moves are often already behind us. Now let's go deeper, because what is happening with silver is not just about market pricing, it is about strategy at the highest level. Some analysts believe China could be preparing for a possible military conflict with the United States over Taiwan within the next 2 to 3 years. Military drills near Taiwan have become more frequent and more aggressive, sending clear signals across the region. In December 2025, the Trump administration approved a massive arms package for Taiwan worth more than 10 billion pounds, making it the largest single defense deal ever approved for the island. That decision sharply increased tensions between Washington and Beijing. When you place that event next to China's new silver export rules, the connection becomes harder to ignore. Silver is not just used in jewelry or coins. It plays a critical role in missiles, radar systems, communication equipment, and advanced defense electronics. The United States military depends heavily on imported silver for production of modern weapon systems. If China limits silver exports while building its own stockpiles, it creates pressure on America's defense supply chain. This is not speculation or internet theory. It is a documented strategic reality supported by public data. If a country expects possible conflict, it secures resources first and asks questions later. Restrict exports, increase domestic reserves, and make sure your own industries have priority access. That is not unusual behavior in times of rising tension. Officially, China continues to say it wants peaceful reunification with Taiwan. But at the same time, it is making economic moves that increase its leverage. Economic pressure often comes before military pressure. If an opponent becomes weaker financially or industrially, it may hesitate before entering a conflict. That is how economic warfare works. Silver, in this context, becomes more than a commodity. It becomes a tool. Now let's zoom out even further. This move by China fits into a broader concept called resource nationalism. Resource nationalism happens when governments decide that certain materials are too important to leave fully exposed to global markets. Instead of free trade, access becomes selective. Instead of equal pricing, domestic companies get priority treatment. Silver is critical to green energy, electric vehicles, artificial intelligence, and digital infrastructure. It is no longer just a precious metal, it is a backbone material for modern technology. China recognized this earlier than many Western policymakers did. For years, China quietly strengthened its control over refining capacity and supply chains. Now it is using that position strategically. Western companies have spent billions trying to reduce dependence on China. Manufacturing was moved to Vietnam, India, and Mexico in an effort to lower risk. Major tech companies invested in factories outside of China to protect their operations. Samsung built large facilities in Texas to reduce reliance on Chinese production networks. But here is the reality. You can move a factory anywhere you want. If China controls the raw materials, you are still dependent. Shifting production does not solve supply dependency if the core input remains controlled elsewhere. That is the dilemma many global companies now face. Return to China for stable material access, or stay outside and pay much higher costs. China's strategy does not block decoupling directly. It makes decoupling extremely expensive. Leaving the system comes with a rising price tag, and that price tag is getting larger. This pressure is not limited to corporations. In late January 2026, United Kingdom Prime Minister Keir Starmer visited China, becoming the first British Prime Minister to do so in 8 years. The visit happened despite warnings from President Trump, who publicly stated that doing business with China carries serious risk. Starmer responded by saying it would be foolish not to engage with the world's second largest economy. During that visit, Britain secured $2.2 billion in agreements with Beijing. This moment showed visible disagreement between close allies. Even nations that align closely with the United States are struggling with the economic reality of cutting ties. When one country controls critical resources, complete separation becomes difficult. This is the leverage that resource nationalism creates. And here is an important point many people overlook. China's move could set an example for other countries. Mexico and Peru are also major silver producers. If they see that controlling exports creates geopolitical power, they may consider similar policies. If multiple countries begin restricting access, the era of cheap and easy silver ends quickly. Global supply chains that once seemed permanent can shift much faster than expected. Now, let's look at recent market behavior, because the situation continues to evolve. In the most recent trading session, silver prices pulled back slightly due to lighter holiday trading activity. Market transactions slowed as traders stepped away before the holiday period. In Shanghai, suppliers held firm on premiums between 1,700 and 2,000 yuan per kilogram above TD pricing. Those high premiums made deals more difficult, but sellers did not rush to lower prices. In Shenzhen, some suppliers cleared inventory at slightly lower premiums between 1,500 and 1,600 yuan per kilogram. This kind of inventory movement is typical ahead of the Chinese New Year holiday. Smelters often build up inventory during the break and release it after markets reopen. The key question is what happens when trading resumes fully. If the Shanghai premium remains elevated, it signals that physical tightness continues. If the premium expands further, it suggests even stronger demand pressure. If the premium narrows sharply, it may indicate temporary stress rather than structural shortage. We do not need guesses. We need to watch the data. Markets always leave clues. Now, let's talk about something more technical but extremely important. The ongoing premium in Shanghai creates what traders call an arbitrage drain. When silver is cheaper in London or New York, traders buy it there and ship it to Shanghai. They sell at the higher price and capture the difference. Each transaction removes physical metal from Western vaults. That flow strengthens Shanghai's market while weakening Western inventory levels. Over time, this process can shift pricing power. For decades, Western exchanges like COMEX and LBMA set the global benchmark price for silver. Paper contracts traded in New York and London determined pricing worldwide. But if those exchanges struggle to deliver physical metal, credibility begins to erode. Trust is the foundation of paper markets. If physical buyers no longer trust delivery systems, they turn to markets that can provide metal. Shanghai's rising premium suggests buyers are willing to pay extra for certainty, and certainty matters in uncertain times. This could mark the beginning of a shift in global price discovery. Instead of London or New York leading, Shanghai could gain influence as a pricing authority. That would represent a major change in financial power structures. For investors, this is not a short-term headline story. It is potentially a generational shift. But intellectual honesty requires balance. Silver has already risen about 147%. Markets rarely move straight up forever. Sharp corrections are possible after such strong rallies. Some technical indicators suggest momentum could cool. A pullback would not destroy the long-term case, but it would test investor patience. There's also the possibility that diplomatic negotiations ease export restrictions. Trade agreements can change quickly in global politics. If tensions cool and export rules soften, some of today's pressure could fade. Industries may also look for substitutes if silver becomes too expensive. In certain applications, alternatives could reduce demand at high prices. High prices also encourage new mining exploration. Silver projects that were not profitable at $20 per ounce become attractive at $40 or $50. However, developing new mines takes years, not months. Supply cannot respond instantly. Paper market mechanisms still exist as well. Exchanges can adjust contract terms or encourage cash settlement instead of delivery. The system has handled stress before. There's no guarantee it fails now. But here's the counterpoint. The bearish view assumes business continues as usual. It assumes China will eventually reverse course. It assumes paper markets can manage shortages indefinitely. It assumes substitution can happen quickly enough to matter. Those assumptions are now being tested by real-world data. LBMA inventories are down nearly 1/3 since 2022. COMEX registered silver has fallen about 70% since 2020. Shanghai premiums remain historically high. These are not random fluctuations. They are signals of structural pressure. You cannot endlessly treat paper claims as equal to physical metal if physical stock keeps shrinking. Eventually, the gap must close. Either supply increases or price adjusts upward to reflect scarcity. China's export policy aligns with long-term planning goals effective January 1st, 2026. This is not a temporary emotional reaction. It is a strategic policy change. The whitelist of 44 approved companies shows that allocation decisions are deliberate. Military considerations add another layer of seriousness. Silver's role in defense electronics is not optional, it is essential. When strategic resources become tools of national policy, markets respond, and those who understand early often position early. The silver story is no longer just about charts and trends. It is about geopolitics, supply security, and global power shifts. Now let's widen the lens even more, because silver is not just an industrial metal, and it is not only a geopolitical tool. Silver is also money, and it has been money for thousands of years across different civilizations and empires. Long before digital banking systems and central banks existed, silver coins were trusted as real value. Unlike paper currency, silver does not depend on a government promise. It does not require a signature, a central bank, or a political agreement to hold value. That historical role matters today more than many investors realize. Right now, the global financial system is under pressure in ways we have not seen in decades. United States national debt has climbed past $36 trillion. Annual deficits continue to run above $1 trillion per year. Interest payments on that debt are becoming one of the largest expenses in the federal budget. When debt compounds at that scale, something eventually has to adjust. History shows that large debt cycles often end with currency weakness or financial restructuring. Countries that understand this do not simply watch it happen. They prepare. China has been accumulating gold and silver reserves for years. At the same time, it has been slowly reducing its holdings of U.S. Treasury bonds. It has also been building alternative payment systems outside of the traditional SWIFT network. These moves are not random. They are part of a larger strategy to reduce dependence on the dollar-based system. When you combine that monetary shift with control over strategic materials like silver, the picture becomes clearer. This is about positioning for a multipolar world rather than a dollar-dominated one. It supports industrial growth through technology and energy infrastructure, and it acts as a store of value during financial uncertainty. That dual function makes silver uniquely powerful. When global trust in paper systems weakens, hard assets often attract attention. At the same time, industrial demand continues regardless of monetary debates. This combination creates strong underlying support. Some investors focus only on charts and technical indicators. Charts matter, but they do not tell the whole story. Behind every chart is policy, supply flow, and geopolitical tension. Right now, those forces are moving in the same direction. Western paper markets have long influenced global silver pricing. COMEX and LBMA became the benchmark centers for futures contracts and price discovery. However, those markets rely heavily on leverage and confidence. Paper contracts often represent many times more silver than actually sits in vaults. As long as most traders settle contracts in cash instead of demanding delivery, the system works. But when physical demand rises and inventories shrink, that balance becomes fragile. Registered silver at COMEX recently fell below 100 million ounces. That number is historically low compared to open contract levels. If more participants demand physical delivery instead of rolling contracts forward, pressure builds quickly. Meanwhile, Shanghai's elevated premium sends a strong message. Physical buyers are willing to pay $20 to $25 per ounce above Western prices to secure supply. That premium reflects urgency. It suggests buyers value certainty more than price efficiency. In commodity markets, sustained regional premiums rarely last without deeper reasons. They signal tight supply, restricted access, or both. This divergence between East and West reflects a larger economic fragmentation. For decades, globalization created smooth flows of materials and capital. Now those flows are becoming more controlled and selective. Resource nationalism, trade restrictions, and strategic planning are replacing open market assumptions. That shift changes how investors must think. The old framework assumed abundant supply and stable cooperation. The new framework assumes competition and limited access. Silver sits directly in the middle of that transition. Now let's talk about what to watch moving forward, because staying informed requires focus. First, monitor the Shanghai premium after holiday trading fully resumes. If premiums remain elevated or increase, it confirms ongoing physical tightness. If premiums shrink sharply, it may suggest short-term stress rather than structural shortage. Second, continue watching LBMA and COMEX inventory updates. If vault levels continue falling, that supports the thesis of sustained demand pressure. If inventories stabilize or rebuild, some of the urgency may ease. Third, observe any policy reaction from the United States government. Will Washington attempt to secure silver supply agreements with Mexico or Peru? Will it invoke strategic production laws to boost domestic output? Government responses often lag market signals, but they eventually arrive. Fourth, pay attention to the gold to silver ratio. Historically, silver often outperforms gold in later stages of precious metal bull markets. If that ratio begins compressing significantly, it signals strong momentum in silver relative to gold. Fifth, monitor geopolitical headlines around Taiwan. Any increase in military tension could intensify resource control strategies. Any diplomatic breakthrough could reduce some of the pressure. Sixth, listen for corporate earnings calls discussing material shortages. When manufacturers publicly mention silver sourcing challenges, it confirms supply constraints. Now let's discuss risk, because no investment story is one-sided. Silver's 147% rise in 2025 is extraordinary. Markets that move that fast can experience sharp corrections. A pullback does not cancel the long-term case, but it can test emotional discipline. Investors must size positions responsibly. There's also always the chance that export restrictions ease if diplomatic negotiations succeed. Trade agreements can surprise both optimists and pessimists. Substitution risk remains real in certain industrial applications. High prices encourage engineers to innovate and reduce material usage where possible. New mining projects could eventually increase supply. But large mining developments often require years of planning, financing, and construction. Supply growth rarely happens overnight. This creates a timing gap between rising demand and new production. During that gap, price volatility often increases. The key is understanding the difference between short-term fluctuations and long-term structural change. Short-term corrections are normal. Structural shifts alter entire market foundations. Right now, we are seeing signs of structural change. Global economic alignment is shifting from a single dominant power to multiple competing blocs. Strategic materials are being prioritized. Financial systems are being questioned. Silver intersects all of these themes. At Alex Carter Reports, our goal is not to create excitement. Our goal is to analyze data and understand context before it becomes obvious. We encourage you to verify every figure independently. The Ministry of Commerce announcements are public information. Vault inventory reports are publicly available. Shanghai premium data is posted on exchange platforms. Use primary sources whenever possible. Your capital deserves careful research, not emotional reaction. Physical silver ownership carries no counterparty risk. It does not depend on an exchange delivering metal. It does not rely on a clearinghouse remaining solvent. Paper contracts, on the other hand, depend on multiple layers of trust. In stable times, that trust feels invisible. In unstable times, it becomes central. Understanding what you own and how it is structured is essential. This is not financial advice. It is educational analysis based on publicly available data. The world is changing quickly. Supply chains are tightening. Strategic resources are being prioritized. In that environment, awareness becomes a form of protection. We are now at a turning point that goes far beyond a single metal or a single policy change. What is unfolding in the silver market is part of a much larger shift in how the world organizes power, trade, and money. For decades, globalization created a system where goods moved freely, supply chains stretched across continents, and most countries assumed cooperation would continue. That assumption is fading, and silver is one of the clearest examples of how fast things can change when strategic interests take priority over open markets. China's decision to tighten export control starting January 1st, 2026 is not just a regulatory adjustment. It is a signal that access to critical materials will now be guided by national interest first. When a country that refines 60% to 70% of global silver supply changes the rules, every industry that depends on that material must rethink its future. The sustained Shanghai premium of $20 to $25 per ounce above Western prices shows that buyers are willing to pay significantly more to secure physical metal. That premium is not emotional trading. It reflects urgency and the desire for certainty in a tightening market. Meanwhile, Western inventories at LBMA have fallen from 31,023 metric tons in June 2022 to about 22,126 metric tons by March 2025, which represents nearly a one-third drop. COMEX registered silver falling roughly 70% since 2020 and slipping below 100 million ounces highlights how quickly available supply can shrink. These numbers are not theoretical, they are measurable and publicly available. Each ounce shipped east to capture arbitrage profit reduces the buffer that Western exchanges rely on to maintain confidence. When confidence depends on physical backing, shrinking inventories matter more than headlines. If demand continues while supply remains restricted, prices must eventually adjust to balance the gap. The market cannot ignore physical scarcity forever. The question is not whether silver will experience volatility, because volatility is certain. The question is whether the long-term structure of the market is shifting in a permanent way. We are watching pricing power potentially move from traditional Western exchanges toward Asian markets where physical demand is strong. If Shanghai continues gaining influence, the global benchmark system that investors relied on for decades could evolve dramatically. That would represent a deeper change than a simple price rally. It would represent a rebalancing of financial influence. Silver's importance to electric vehicles, solar energy, and artificial intelligence means industrial demand is not a short-term trend. Green energy infrastructure alone requires steady silver input for years to come. AI data centers and advanced electronics continue expanding as digital transformation accelerates. Defense applications add another layer of structural demand that is unlikely to disappear. At the same time, the monetary role of silver remains relevant in a world where debt levels exceed $36 trillion in the United States and deficits surpass $1 trillion annually. When governments carry that much debt, investors naturally look for assets that are not dependent on political promises. Silver offers both industrial utility and historical monetary value in one form. That dual nature gives it resilience that many assets lack. However, smart positioning requires acknowledging risk as well as opportunity. A 147% rise in a single year is powerful but also extreme. Sharp corrections can happen without warning, especially after strong rallies. Investors who chase momentum without understanding fundamentals often struggle during pullbacks. Diplomatic shifts could reduce export restrictions faster than expected if geopolitical tensions ease. Substitution technologies could reduce silver intensity in certain products over time. New mining projects could eventually expand supply if high prices remain attractive long enough. Paper market structures at COMEX and LBMA still have tools to manage delivery pressure through contract adjustments and settlement changes. None of these possibilities should be ignored, but none of them erase the data we see today. Resource nationalism is rising across multiple sectors, not only silver. Countries are increasingly prioritizing domestic needs over global efficiency. That trend suggests material access will remain a strategic issue rather than returning to old patterns quickly. Mexico and Peru, as major silver producers, are watching closely. If they adopt similar policies in the future, global supply flexibility could tighten further. The era of assuming permanent, friendly trade relationships appears to be ending. In that environment, owning assets with no counterparty risk takes on new meaning. Physical silver held directly does not depend on an exchange clearinghouse. It does not rely on a futures contract settlement. It does not require trust in a third party to exist. Paper claims, on the other hand, depend on multiple layers of financial stability. During calm periods, those layers feel secure and invisible. During periods of fragmentation, they deserve careful review. This is not a call for extreme action, it is a call for awareness. Understanding what you own is more important than following excitement. The silver story is part of a broader global transformation from a single dominant economic system toward multiple competing blocks. Power is increasingly measured not only in currency strength, but in control of resources. Strategic materials like silver become bargaining chips in that competition. Governments are thinking long-term even when markets focus short-term. Investors who recognize structural trends early can adapt before shifts become obvious. The ones who wait for full media coverage often enter after major moves have already occurred. At Alex Carter Reports, the goal is to connect policy announcements, inventory data, and geopolitical events into one coherent picture. We focus on publicly available information and encourage independent verification of every figure. The ministry announcements are accessible. Vault data reports are accessible. Price premiums on exchanges are accessible. There is no need to rely on rumor when data exists. Watching how Shanghai premiums behave after holidays will provide important clues. Tracking weekly inventory changes at LBMA and COMEX will reveal whether drainage continues. Monitoring policy responses from Washington and Beijing will show how governments react to tightening supply. Observing the gold to silver ratio will highlight relative strength within precious metals. Paying attention to Taiwan developments will clarify geopolitical pressure levels. Listening to corporate earnings calls will reveal whether manufacturers feel sourcing stress. Each piece adds context to the larger puzzle. Silver is no longer just a trade. It is part of a strategic narrative unfolding in real time. Global fragmentation means supply chains, once considered permanent, can shift quickly. Industrial expansion in clean energy and technology continues regardless of political tension. Debt pressures in major economies increase interest in tangible assets. All of these forces intersect in one metal. The coming years may define how commodity markets operate for a generation. Price volatility will test discipline. Headlines will swing between optimism and fear. Policy statements will create sudden market reactions. Through it all, focusing on verified data rather than emotion remains essential. Protecting capital comes before chasing opportunity. Risk management matters more than excitement. Assets without counterparty exposure provide one layer of resilience in uncertain times. Paper markets may continue functioning smoothly, or they may face delivery stress if inventories tighten further. Confidence will determine which path unfolds. History shows that financial systems evolve when trust shifts. We may be witnessing one of those periods now. Silver's 147% surge in 2025 reflects recognition that structural forces are changing. It reflects industrial demand, strategic positioning, and monetary hedging happening simultaneously. It reflects a world that is less unified and more competitive. Whether this transition accelerates or slows will depend on decisions made in Beijing, Washington, and other capitals. But the data today shows tightening supply, rising premiums, and shifting power dynamics. Those signals deserve attention. Stay informed, verify independently, and think long-term rather than reacting emotionally to daily price swings. The global landscape is evolving. Strategic materials are becoming central to economic security. Silver stands at the intersection of industry, defense, and money in a way few other assets do. That reality alone makes it worth watching carefully in the years ahead. We will continue tracking the numbers, the policies, and the global shifts that shape this story here at Alex Carter Reports. Because understanding change early is often the difference between reacting late and preparing wisely.